Hello, my name is Eddie Tofbig. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. The key move here in recent times, as I said last week, has been the move back down below the super significant 50% absolute Fibonacci line at 218 3/4. This has now quashed the idea of a handle, a specific pattern addition to a rounded bottom, and also a bull flag come bullish half hesitation pattern formed from about mid-February to the end of May. Thus the primary target at 221 1/4 has been achieved, but the secondary harder to reach target is now retired. Now, unlike some of the other grain markets, we do not really have a double top pattern here, lopsided or otherwise. What we do have, or maybe should I say did have, was a mid-February to date uptrend, currently broken at 211 1/4. That might have been part of a very big February to date bull channel. As I said last week, and I quote, "But a lot of this is just speculation right now, as even the bull channel is at most a 4-pointer and does not have the necessary touches. However, for now, this is all the bulls out there have to hold on to." End of quote. Well, since last week the uptrend has risen and the market has fallen, though prices did hesitate for quite a while on the 208 to 212 area, thus giving the impression of a possible hesitation. If this hesitation were to become part of a corrective hesitation in a large mid-May to date action, then we would have possibilities of prices initially reaching 204 1/4, which is not too far, and a little under the rising mauve medium moving average below, plus the lows of May and April around the 204 even zone, as well as the congestion seen between December 2018 to February 2019 between 204 even to 208 even. So perhaps this might be a bit more substantial as support, as it might seem at first glance. Nevertheless, the secondary harder possibility, still a possibility, is down at 194 even. Much as I said in Kansas City week, this is an early speculation on my part, and it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. Minneapolis wheat. After consecutively closing below the recent mid-April to early May bullish shift pitch hook, now retired, I was on the lookout for what would be the next main pattern here, and well, it seems to be an old pattern, but with a new twist. Prices dropped down to the broken and possibly revived tripled up bull channel, currently 644 even to 663 1/4, but with the added twist of the rising mauve medium moving average running through it, which is currently at 647. That is not all. The congestion, 650 to 651 3/4, around the August 2018 high at 650, eroded the bearish incentive, as did the earlier supports now turned into resistances of the 50% Fibonacci line, the May 24 to May 25 move at 622 1/4, and the overhead green short medium moving average currently at 678 1/2. Though to be honest, you wouldn't have really noticed it on the way down. Prices are now seemingly settling a little on the tripled lower bull channel line, currently at 644 even, and the lesser Fibonacci line at 644 1/2. Now, I'll address this possible hesitation shortly, but I want to emphasize the importance of the break last week below the significant 50% Fibonacci line, the May to August 24 move at 669 1/2. As I said last week, and I quote, "The importance of this 50% Fibonacci line is that it is also the base of a mid-April to date double top, Adam and Eve type. The break below the 50% Fibonacci line is the follow-on move lower. Thus for this pattern we have a primary target X2 down in the 635 1/4 zone, right on the April 24 low. For secondary harder to achieve target X3 down in the 606 even zone. right on the April 21 low. Right now, the market's been halted by the slowly rising mode medium moving average, currently 647 even, and I'll be very interested to see if the market can make that short leap lower to the April 24 low. End of quote. So far, we have not seen that leap lower, but a stumbling around for a week or so between about 640 to 655 even. This is where I deal with that hesitation, because if it is a corrective hesitation, then we might possibly have a larger move lower. From the end of May, two-day action of initially a possible move down to around 618.25 area, and a secondary harder possibility of a move down to around the 569.5 area. Now these are not targets yet, just possibilities, and it will only happen if what we see this past week or so is a corrective hesitation. However, much as I said in Kansas City week and in Paris Milli week, this is early speculation on my part, and it may not happen, but I'd rather get it out there now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. London UK feed wheat. There are two key long-term patterns here to bear in mind, with a common neckline extension highlighted in dark blue on my daily chart. I will shortly detail these patterns, but first I would like to discuss the recent action over late April, May and now June. First off, we are still within the purple end of June to late October 2025 bullish shift pitchfork, in between the purple middle time above, currently at 184.20, and the purple lower time below, currently 162.25. Sorry, 162.65, my apologies. However, the main pattern we created has been the late April to late May head and shoulders top. We broke down through the neckline of this pattern, currently at 186.10, 2 weeks ago, and reached down to both the primary and hardest to reach secondary targets easily enough. So, we now need to discuss whether the action of the last week and a half, whether it is a halfway hesitation in formation. Well, it's too early to say, but if it is, and it may happen in between my commentaries, then we would have an initial possibility down in the 170 even zone, close to that key neckline extension, and the slowly rising gold long moving average, which is currently at 169.05, plus a harder to reach secondary possibility down in the 162 even zone, where we have the congestion from autumn and winter 2025 and spring this year. These are not targets yet, just possibilities, and will only happen if what we see this past week or so is a corrective hesitation. However, much of us, as I said in Kansas City week and Paris Milli week, and also in Minneapolis week, this is early speculation on my part, and it may not happen. But I'd rather get it out there and now and look foolish than look a bigger fool if prices start motoring lower in between my commentaries. So, with all this in mind, let me now discuss the longer term points once again, the same points I have been discussing here for well over a year and a half, and some of them were things that I noted back in my annual commentary back in January 2025. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 23 to April 25 bearish cat's ears pattern. And that's akin to a double top pattern but formed after a big fall such as the fall we had in early 2023. As well as this, we have an even longer term second pattern, an August 20 to April 25 very large head and shoulders top pattern. These two super long term patterns both rely on one single feature, and that is their common neckline, which is highlighted in purple on my monthly chart, currently 169.25, same as on the daily chart I just spoke about. Now, for the bearish cat's ears pattern, I think it's safe to say its time has come and gone, but we still can look at the long-term head and shoulders pattern as a still live, with a primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 250 or so charts. The 1975 to date, yes, a half-century old uptrend, which is currently at 66.30. I'm not even going to give you my secondary harder to achieve target for this pattern. It's below zero. Please bear in mind these are very long-term targets stretching possibly over many years, but they are still targets below for these patterns above. Now, that all being said, July 2025 with changeover through a major spanner in the works for such long-term patterns. The reactionary immediate countering monthly key reversal up for July last year went back above the purple neckline but stopped at the 50% absolute Fibonacci line at 180.5 and just under the bright green 2023 today upper bear channel line. It's currently at 169.10. The question this posed, and it's a longer term question, is whether July 25 was just a reactionary single month move higher or the beginning of something else. I've said for about 2 months now that these two bearish patterns will not be the way forward, and that what we have is a base for a move higher. March provided a single monthly close, barely, over the bright green upper bear channel line. April did much better, for clean, clear close higher. However, I have said repeatedly that I would like to see a minimum of at least one more month, ideally the close of May over the bright green upper bear channel line, to verify this move higher, and ideally over the 50% absolute Fibonacci line at 180.5. Well, we had a strong close for May, but the pattern for May was a bearish one, a shooting star pattern, type 1 bearish, and June has already started a gapping lower move with a follow-on down. This now throws the idea of a reactionary move back up into one heading back down as prices seem set to move down to the important common purple neckline once more. And it does raise the question whether the whole 2023 today action could be the start of yet another pattern, perhaps an opportunity for a very large reverse head and shoulders pattern, perhaps. So watch this space. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.